You there, Mahesh?
Yes, Jose, I'm here.
Great sound today. So guys, we're just listening on the background. Audio Mercados is one of those news live squawks. So basically, the latest news is we're receiving information from the United Kingdom. They are not going to change the date as far as what's going to happen with Brexit. They're just keep going with anything that they have on the table. And the news is they're not going to change any dates as far as Brexit goes. That's the latest on the Brexit saga. Mahesh, you say you have something. Welcome, guys. As usual, this is the War Room. My name is josericaurte.jaen, and directly from India, we have our favorite data scientist, Mahesh Taank. Go ahead, Mahesh. The floor is yours. I'm just going to...
Thank you so much, Jose.
Stop
Let me share my screen.
Go ahead.
So talking about the Brexit news, I think that's calling for GU shorts, I think.
Absolutely. It's going to place some extra pressure. No needed, by the way. No needed pressure at this point in time with everything we have everywhere. But, well, it is what it is. I guess fighting over a trade agreement is the number one thing rather than just have some calm in Europe.
Yes.
What can we do?
Okay. All right, great. So, Jose, I want to talk about shorting Euro USD. Let me just show you what I'm seeing here. You know, I'm using the currency strength indicator. It actually tells us where the currencies stand. Are they weak or strong? So what I'm doing right now is just eliminating the currencies that we want to see. So here at the top is 1 hour, and on the bottom I have the half an hour. Let me just show you how it's playing out. Just have a look. On the 1 hour, the strength of USD is 71 and Euro is 46. And we actually see the USD is curving up and the Euro is actually falling. And the same thing is confirmed. Let me just annotate that. Same thing is being confirmed on the lower time frame, which is the half an hour too. The USD is actually, going up and Euro is tending to fall down. And so let's just have a look at the chart, at the Euro USD chart. Just have a look here, Jose. Such a clean structure we see here. As usual, as I told you before, I'm using the pivot points here. So this was the daily pivot point. It is trading well below the pivot point. And this is the support zone, support 1. And right over here, let me just draw a rectangle so that it's clear for us. This was an accumulation zone where it was just trying to accumulate or gather liquidity is the right word. But technically talking, this is the distribution phase because they're trapping the buyers and preparing to go short. So what happened over here is we see multiple times, it tried to test and break through this particular level, but it failed. The first attempt, second attempt, third attempt. And if we count all this, also have a look at the volume. On this particular candle, we have a great sell volume. So talking about volume, I'm also using the quantum tick volumes here, also from Anna Cullins. What it does is it paints a volume color corresponding to the price action. So if it's a bullish candle, it's going to paint a blue one. If it's a bearish price action on the candle, it's going to paint the, the red color. It makes it very easier and very quick for us to spot the trades. So what's happening here is just have a look how the volume is increasing. This rejection candle is associated with this volume. And this is the average line. The volume is well above average. And right over here, we see the volume, the sell volume actually increased. And have a look at the currency strength, 72, 46. Everything is calling for shorts. This zone, this strong zone was not broken. It could not go above. So when I spotted it at this point. It had just completed the rejection. So my idea I went short, took the entry right over there, 1.09280. The stop loss is right above this zone and expecting at least, up to the S2 support. I think it can go all the way because you see here, this is the free zone. We don't have much resistance or much support in this zone. So we can easily take the target to right to the 200 SMA. Let me just see what in terms of risk to reward, what it can be. Okay, 21 pips or 22 pips, you can say. The first take profit could be at this level, 1.0893, which is 33 pips. That's 1.5 risk to reward. Then right over here, it's above 3, 1:3. Or right up to the EMA, it should be anything about 1:3 risk to reward. Also, additional confirmation, Jose. Let me just show you. This is the DX index, the US dollar index that we are seeing on the screen right now. Let me just delete this. Okay, have a look at the price action on the USD index. Buying volumes, strong buying volumes, and a corresponding candle. This is where it retested this particular resistance. It broke above the resistance. It found support on the EMAs, and again it found support on this resistance. And now, as we can see, it's just going really strong. And we see the highest volumes have been the buy volumes, not the sell volumes. Jose.
Absolutely. No, I think, and I will just take your screen real quick. Can you go back to the dollar index? Just go back to the dollar index for a moment.
Sure. Let me give you control, Jose, so you can use
it. No, I can take notations. That's fine. Yeah, it's easy this way. I can easily see to spot that we're looking at a 99.74. But based on market cycles, and I have no doubts that this is the completion of initial cycle, a minor cycle, we still have to the upside. We have pending. This cycle was never completed in this area, so you're missing this. We're missing this. It indicates at least a retest of 120. And at the same time, this cycle with this supply zone is a virgin supply zone. I totally see we still need to retest minimum 180, 190 for the US dollar index, symbol DXY. And in the same direction of your analysis, this is calling for more dollar strength. The greenback is not done. And I think a lot of people were counting down just because we have this negative amount of fundamental coming from the higher percentage in unemployment. And that's fair enough to say. But at the same time, we still have the pressure in emerging markets coming from nations. Just today, we have a horrendous, one of the worst GDPs coming from Hong Kong. And that for sure, I talked to you about it. That will put some pressure on the Hong Kong dollar. The Singapore dollar is not different. And Thailand has a huge percentage. Shame on me, I can't share with the audience the percentages. But the percentages that of capital flow that comes from tourism, it matters a lot. So the Thai baht is another currency that will probably will have to devaluate against the US dollar. So this is putting a lot of pressure in the US as the mechanism of funding is the US dollars. They want to take down the dollar, but these countries, they just don't help. They just don't help, man. It's just difficult. So that's what it is. Hey, Mahesh, thank you so much for this one. Let me share my screen now. I will take the floor for a moment and close with a quick overview of what is happening with the Nasdaq. And the way I like to share that view, I do that via QQQ. That's the ETF. And this is how I express my views on the Nasdaq. Now, we all know, I have said this so many times, the Nasdaq is the reason why we still have a stock market to trade, or markets in general. 30% of the index, all the weight, it's based on 5 companies: Facebook, Apple, Amazon, Netflix, and Alphabet, Google. So everything is going to depend on what they're doing. And after this pandemia, the heat of the coronavirus, those companies are the ones hiring. Those are the ones doing the hiring, believe it or not. You still have Amazon putting on the table probably close to 100. I will say that at the end of the day, they will have to hire worldwide close to 200,000 people. Now, it may not sound like those 200,000 workers is a big deal compared to the number of unemployed individuals. Still, it's a lot for a company to take. Imagine just the amount of HR hours that you have to just clock to get it done. The whole thing, contracts, it's amazing. Now, quick view just to finish this U.S. opening bell. And we promise, guys, that we're going to come back with the opening bell. We're going to give you the sound effect, ring, 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 all that, all you want. So you have the full experience. Now, judging to the right, we have volume profile. What it is, as Mahesh explained, a little bit different from the one that Anna Cullins uses. This one is based on Trading's View data, the data they bring from different companies. And what it entitles is executed volume. It gives you a map. And that's what we need to know. Where is the action, or where the action took place? And these are the levels. For example, no surprise, we have this big to the left. You have this 1, 2, 3, 4 daily bars, accumulation process, not something that may surprise us. The fact that it's at the 200 level, 199 to let's say 202. On QQQ, we have this node, this node, long node of volume. Then we have the empty zone, the free zone, the free space that you see here, and it goes all the way up to this level. Not a big challenge, pull back, then continuation. But we want to, the way we want to use this tool is basically just to give us an idea. Here's the basics. If we have a clean break, and I'm using one of Mahesh's favorite quotes, clean break, we go straight all the way down to 200. That means that QQQ may lose 10. We have again another report. Let's see. So basically the manufacturing index, 35 points versus the 40 points in March. That's 35 for April versus 40 points that we had in March. So more macro data that is just going down. And this is just pretty much what everyone's expecting. Like I said, a clean break will take the this ETF that follows the underlying asset is the Nasdaq, the technological index. We just go straight to this level. Now, continuation will require it to find a balance at the point of control and slowly climb up all the way to 218, which already did. So now we'll need an open, a close and open above this level to then see if we can move to 222, eventually to the left, closing the gap in this little area and move it up all the way to 230. Is that going to happen in the next couple of weeks? I don't think so. I may think that there's going to be a push that will lack conviction based on the current state of the market. We have a hyper extension. If you take a look at this, let me use trend Fibonacci real quick just to give us a better idea. We take the known bottom all the way to the known high, and this is what we have. Now, see that the 38.2%, I'm just going to zoom this so we can all have a 38.2% Fibonacci will come down to the 200 level. Again, Mahesh, it's not a surprise. We see the big knot of volume executed at that level. Absolutely. If we have a clean break, we know what's going to happen. We know that it will take us to 185. That will be the 61.8% Fibonacci. There are no surprises at all. One thing I want to point is breaking the 200 mark does not constitute a bearish trend. What it means, if we look at the structure of what is happening so far, it will convey that we are looking for a deeper correction. We are, in fact, in some like to think it's a bearish market. I like to say that the evidence suggests something different. We'll look for a deeper correction rather than correct to this level. Just gonna leave it there. We have a deeper correction to the 61.8% from Fibonacci, and then retest of the previous high, this level. Retest. And what can easily happen is one more push to 38.2%, and then finally explosive. And as you can see, Mahesh, this is just a one-on-one structure trend, structure formation. There's nothing fancy here. A lot of like to think that we're in the verge of a recession. Not at all. Yeah. What it will do may create a hyperinflation. No one talks about it, and I don't really want to go deep into this. But as far as trading, this is our trading map, and it has nothing to do at the end of the story, at the end of the day, with what's happening in the economy, because we know there's a dislocation between the markets and the economy, and there's a high level consumption of digital products. They require little labor and zero to non-inventory. So that's something that we have to consider. Mahesh, do you have any final words?
Nothing, Jose.
Okay, perfect. So guys, let's see let me quickly share my screen so we see a few of the ideas. I've been adding a few ideas. I closed one idea, actually break even with the client. Not sure if we're still in, but definitely we didn't lose any money short pound versus US dollar that I explained at the beginning of the video. I closed my position for our files, our reports. Was a nice profit with 10 lots. Still, a few positions are bleeding a little bit, trying to fight a lot of Jen crosses. They're just making what I believe, Mahesh, there's dead cat bounce. They're really going down. They're just pretending that they're going up. And a small position long dollar Jen, another short position in Euro Swiss franc, both in the green. And here we keep playing with this hedge. So far, the euro versus US dollar, based on what you're saying, I already had it before. Yeah. It's in the hedge. It's still 30 by 30, slightly into profit. We do expect, as you said, I will be looking for at least 0.63, maybe lower, probably lower, depending how it moves. But at the end of the day, once it moves to the range of 108, I will be really considering taking the profit in the short and get ready to go long the euro. We'll see how it goes. We still have 56 hours before the most important data this week, non-farm payroll. Thank you, everyone. As usual, remember, this is and always will be the War Room. See you tomorrow.